update presented by Intuit. My name is Amy Grimes, and I will be the moderator for today. And at the end of the session, I will be assisting Mike with some questions and answers that have been asked by our previous audiences. I would like to take this opportunity to introduce Mike DeValio. He is our resident tax expert and will be providing you the tax law update for this afternoon. Mike?
Thank you, Amy. Good afternoon, everybody. Welcome to the 2014 Tax Law Update presentation with special emphasis on the Affordable Care Act. Again, I'm Mike DeValio, CPA and Senior Tax Analyst with Intuit's Professional Tax Group. Please follow our new training forums for the latest updates, or you can click on the Resources tab to access these links and a PDF of today's presentation. As of a couple months ago, we did a survey, and less than 7% of the respondents or tax preparers were feeling very prepared for this season as a result of ACA. Hopefully that gap has closed a little bit as we head into tax season. So we felt that it was very important to help you be prepared for these conversations with your clients, and consequently we've been adding quite a bit of training and tools to help you and your firm get up to speed with these important tax law changes. And I'll go over all this information throughout the course of the session. And here is our bulky agenda for today. We will talk about the new 1095 source documents, the individual shared responsibility provision, health coverage exemptions, the premium tax credit. We'll do some product demonstrations to show you how these provisions are working within our tax products. Then we'll go over the small business health care credit, employer shared responsibility provision, which just took effect a couple weeks ago. Expired provisions that were recently extended, some miscellaneous tax law changes, and an important IRS initiative that we'll talk about. The following source documents will be used to support the ACA computations. You can view them like a W-2 or a 1099, where you get information and it helps you prepare the return. And the IRS gets a copy of those documents as well. So beginning in 2014, you'll see a new 1095-A, which is issued by the Health Insurance Marketplace. And then beginning in 2015, but you may see some of these in 2014 since they're optional, 1095-B health coverage statement. And finally, a 1095-C employer-provided health coverage statement. So first off, again, this is mandatory for 2014. Health Insurance Marketplace Statement, providing information necessary to complete the 8962 premium tax credit. It's going to show you coverage by the month that the taxpayer would have had, advance payments of the premium tax credit, the premiums themselves. It's sent to anyone who enrolls in a health plan through the marketplace, whether or not you're eligible for the premium tax credit. And this information is also reported by the marketplace to the IRS. And here's a snapshot of the draft. The form has gone final, but there were no changes to speak of, so I didn't change out the screenshot. Some of the important call-outs here. Part 2 shows those who are covered under this policy, and it's going to indicate the dates that the coverage applied. And that will be important for turning off the penalty calculation. Then we have Part 3, household information for members in the household who would have had coverage, monthly premium amount that they paid, the monthly, or actually I should say the monthly premium amount, the gross amount before the subsidy, Then in column B, monthly premium amount of the second lowest cost silver plan. And that'll make more sense when we show you the computation of the credit. And then column C, the monthly advance payment of the premium tax credit. And those are those upfront subsidies that the taxpayer may receive. Next, we have a 1095B. Again, these are optional for 2014, so you may not get this statement. It's a health coverage statement issued by a government-sponsored program, eligible employer-sponsored plan, individual market plan, or miscellaneous coverage plan, providing information about whether the taxpayer, spouse, and dependents had qualifying health coverage or minimum essential coverage for some or all months during the year. If you have minimum essential coverage, you're not subject to the individual shared responsibility payment or the penalty for a given month. And again, here's a screenshot of what the 1095B looks like. The important section to call out there is Part 4. It's going to list out folks in the household that are covered under the policy, and there's a box check for coverage for all months or individual months throughout the year. Lastly, of the source documents, we have Form 1095-C, employer-provided health insurance offering coverage. Again, this is optional for 2014, but mandatory beginning in 2015. And there is some overlap potentially with a 1095-B, because the B is issued by the provider, whereas the 1095-C is issued by the employer. So there could be some overlap. The IRS has not fully addressed those, but you could receive both of these documents. Issued by employers with 50 or more full-time employees, they're required to file the 1095-C with the employee and the IRS. It's going to include information about whether an employer offered qualifying health coverage to an employee, spouse, and dependents for some or all months during the year. And the 1095-C is used to determine, number one, whether the employer shared responsibility provision applies, and that mandate kicks in 2015. Number two, whether the individual shared responsibility payment applies. And three, eligibility of the employees for the premium tax credit has some ancillary implications on the premium tax credit. Screenshot of the 1095-C. Important sections, Part 2. It's going to show offer of coverage and the employee share of the coverage. A lot of that section goes to the employer mandate. Part 3, similar to the section in the 1095-B where it's going to have a big grid with the names of those in the household and whether they had coverage either for the entire year or for certain months. We took a look at some of the numbers that the government has issued this year, estimated impact of the Affordable Care Act. In total, 147 million taxpayers, individual tax returns. Government's estimating 94 million will be covered. So potentially 64%. All you'll do is check a box, and I'll show you that on the 1040, and you're done. 30 million or so may be subject to the penalty. 23 million or so may qualify for an exemption. And finally, 6.7 million may qualify for the premium tax credit, which is issued to low and moderate income taxpayers. Some possible pain points for this year. The fact that the 1095-B and C are optional, and the IRS doesn't expect many to get filed. So what do you do as a tax preparer to find out whether your clients have coverage? The government did address this. They said, according to the IRS, or that's right, they said there's no formal due diligence required or documents that you're required to obtain. I think you have to apply a reasonable level of common sense in terms of determining whether the taxpayer has coverage or not. Practitioners need to do the best they can to make sure taxpayers are represented in good faith, that they have a level of health coverage that will ensure they don't have to make individual shared responsibility payments. Taxpayers could provide a variety of information showing they had coverage through an employer or a private insurance company, for example. In some cases, we're going to have to take oral testimony. So that's all they said about due diligence. Some also potential pain points around the exemption process, although the Form 8965 does address a lot of those concerns. Okay, now we're going to talk about the individual shared responsibility provision, or the individual mandate. The penalty is reported on a worksheet in the Form 8965 instructions, and it carries to the 1040. The provision requires that you and each member of your family for each month have qualifying health insurance or minimum essential coverage, have an exemption, or finally make a payment when filing a tax return. Good news, vast majority of taxpayers, that 65% figure, will have health coverage from one source or another and will only need to check a box on the return. And here's the box. You're probably already familiar with it. Line 61, healthcare. So if you have a penalty, it's going to go on line 61. Otherwise, you check the box if everyone in the household has coverage, full year coverage. For 2014, the annual shared responsibility payment is the greater of 1% of household income above the filing threshold, or the family's flat dollar amount. This year it's $95 per adult and $47.50 per child under 18, and it's limited to a family maximum of $285, which is 3 times the $95 figure. And this is all computed on a monthly basis. So it can flip-flop. 1% could be greater in one month, and the flat dollar could be greater in another month. And the other piece of good news is that this is all pretty well automated via a worksheet that the IRS produced, and then the software does a good job in automating these computations. So really all you have to do is collect information about whether the family members had coverage or not, and all these computations are done for you. The maximum penalty is limited to the cost of a national average premium for a bronze level health plan, and that's also built into the worksheet. What's considered minimum essential coverage? Employer-sponsored plans, including COBRA and retiree coverage, coverage purchased in an individual market and new marketplace, coverage under specified government-sponsored plans, such as Medicare. And if you look in the 8965 instructions, they do a good job elaborating exactly what minimum essential coverage is all about. They get into if you have foreign coverage, does that qualify? Okay, this penalty is phased in over 3 years, and we're in the first year, 2014. It's going to be the greater of 1% of household income over the threshold, or $95, flat dollar amount, and it's going to be half of that for those under 18 years old. 2015, it goes up 2%, greater of 2% of household income over the threshold, or $325 per adult. 2016 and thereafter, greater of 2.5% household income over the threshold, or $695 per adult. Okay, next, health coverage exemptions. If you meet certain criteria, you'll be exempt from the penalty and won't have to obtain coverage. Exemptions are obtained from a marketplace or the IRS, depending on the type. All exemptions are reported on Form 8965 and attached to the return. Exemptions from the marketplace need to be obtained at the earliest opportunity, and exemptions from the IRS can be obtained only by filing a tax return. And I'll show you the 8965 later when we do the use cases. And it's a little tricky because there's a group of exemptions where we're physically claiming them on the tax return. And then the other exemptions where you may have gotten them through the marketplace, the IRS still wants to see those exemptions and the exemption certificate number on the 8965. Some of the exemption types. You can be a member of a recognized religious sect conscientiously opposed to accepting insurance benefits. You can be a member of a healthcare sharing ministry, a member of a federally recognized Indian tribe. If you have no filing requirement, you're also exempt. Short coverage gap, less than 3 months, you're exempt for those 2 months. And you can have only one short coverage gap exemption within a year. There's a multitude of hardship exemptions, and I'll show you those in a bit. No affordable coverage, which means over 8% of my household income is attributed to insurance. Incarceration, I'm exempt, and not lawfully present in the United States. Okay, here is the chart that shows you in better detail what the exemptions are all about. So you can read a nice short description, and this comes right out of the 8965 instructions. On a few of these, they elaborate even more and do some examples. So I recommend that you pull down the 8965 instructions. And then if we pan over to the right, there's a check mark if these exemptions can be granted by the marketplace. The next column, whether these exemptions can be claimed on the tax return. If they are claimed on the tax return, then you'll need to issue a code on the 8965, and that's in the last column. And you'll notice on this first sheet, all these exemptions can be claimed on the tax return. The first one, income below the filing threshold, there's actually a space for that on the 8965 instructions. Income below the filing threshold. Okay, here's the second part of the exemption checklist. Continuing on, about halfway down, all the ones above that line can be claimed on the tax return. And then the last bucket of 2, 4, 6 exemptions, they need to be claimed at the marketplace. They cannot be claimed on the return. A lot of those are around the hardship exemptions. According to the IRS, in any case where taxpayers could apply for the exemption either through the IRS, meaning the tax return, or through the marketplace, better to do so through the IRS. That process is more efficient and does not involve getting letters from the marketplace. So that's good news. If your client hasn't done anything yet, and those exemptions can still be, or they can be claimed on the return, that's the best place to do it. Okay, the premium tax credit. Health and Human Services administers the marketplace and advance payments of the premium tax credit. And the marketplace deals with health insurance options, purchases, and financial assistance. Please go to healthcare.gov for more information. They have some good info on some of those hardship exemptions. Premium tax credit. If you get health insurance coverage through a marketplace, you may be eligible for the premium tax credit, which is available to people with low to moderate incomes. Any advance payments received during the year are subtracted from the premium tax credit calculated on the return. Now, these advances are optional. In other words, the taxpayer could claim to get the full credit on the tax return, no upfront subsidies. The other thing to point out is that the subsidies typically go over to the insurance company. so the taxpayer only pays the net amount for the monthly insurance. You may be entitled to more credit or have to pay a portion of the subsidy back, and this would impact any tax refund or balance due. Whether you receive a subsidy during the year or not, you must file a Form 8962 with your federal income tax return in order to reconcile the subsidy and the credit. That's because the subsidy is figured out at the beginning of the year, and it's based on estimates. Then the 8962 is actually figuring out what the true credit should be at the end of the year based on the actual numbers, household income and such. The credit applies to taxpayers with income between 100% and 400% of the federal poverty line for a given family size. It cannot be claimed as a dependent on the return, and if married, you must file a joint return in most cases. You must also have a coverage month, which means be enrolled in a qualified health plan through the Marketplace. Cannot be eligible for other minimum essential coverage, such as an employer plan, and the premiums must truly be paid by the taxpayer. And this slide here shows the brackets for the federal poverty line based on family size, and it's a look-back type provision. Since you would have gone to the Marketplace at the beginning of 2014, they look at the 2013 federal poverty line. For one individual in the household, 100% of FPL is $11,490, and 400% is $45,960. Family of two, the range is going to be $15,510, all the way up to $62,040. Family of four, $23,550, all the way up to $94,200. And again here, with the premium tax credit, the IRS did a very good job with the 8962, automating a lot of these computations. And then the software, in turn, does a good job with those forms and instructions. So as long as you collect the right information on the 1095A, then the credit should be figured out correctly for you. Major changes in circumstances, marriage and divorce, increases or decreases in the number of dependents, changes in an individual's residence, job or other changes increasing or decreasing income, loss of other health coverage, and changes in filing status. You need to report these changes to healthcare.gov or the state marketplace website promptly. So hopefully the taxpayer did this throughout the year. It can affect the eligibility and the amount of the premium tax credit. Reporting these changes will help ensure the receipt of the proper amount of advance payments of the premium tax credit, so you won't be surprised when filing the tax return. One of the big cases to point out here is if you're figuring income, estimating it to be low, which would pump up your advance subsidy, but then let's say income goes up, to get a promotion or change jobs, then if they don't make that change over at the Marketplace and adjust the subsidy, then you're going to have to pay a lot of that back potentially at the end of the year. Now the government does put caps on what we need to pay back, advance repayment limitations, and it's based on household income as a percentage of FPL. Household income less than 200%. The most you have to pay back for a single filer is $300. Other filing statuses, the limit is $600. Between 200 and 300% of FPL, the most you have to pay back is $750 for single filers and $1,500 for other filers. Between 300 and 400% of FPL, the limit is $1,250 for single filers and $2,500 for others, and then no limit if FPL is 400% or more. Okay, now I'm going to take time out from the PowerPoint presentation and show you how these calculations are working in the tax products. So first we'll go into Lacert here, and I'll show you the credit calculation. We have a pretty basic scenario. We have a taxpayer spouse joint return, 2 dependents, one under 18, one over 18. We have fairly straightforward facts here, 50,000 of income, and then you probably saw these already. These are the ACA screens that we have, and there's 4 of them, 3 for the source document, 1095A, B, and C, and pretty much field by field we replicate what's on those source documents. Then we have a miscellaneous screen, which I will show you in the next client. Goes through the exemptions and such. So what we're showing here is the 1095A. We have everybody in the household is covered by insurance through the marketplace for the entire year. And then we're saying that they had $500 a month of a monthly premium. Second lowest cost silver plan is $400 per month. And the monthly advance payments of the premium tax credit is $100 per month. We go ahead and calculate the return. And we go to the 8962. So we have 4 members of the household. We have $50,000 of modified AGI. If we had dependents who are claimed on the return but are filing their own tax return, this form wants you to pull in the modified adjusted gross income for those other dependents. That would get added in here. Modified AGI is basically adjusted gross income with some add-back items such as tax-exempt interest and the foreign earned income exclusion. Then we looked at federal poverty line. It can vary whether you're in Alaska, Hawaii, or any other states in DC. 23,550 comes right out of the instructions. So 212% household income as a percentage of FPL. Then we go back in the instructions, look at a table, and we come up with a 6.72% figure. Multiply that by line 3, which is the household income, and the amount we're left with is $3,360. And that's what the government is saying that this household can afford in insurance. Then they figure that on a monthly basis to $280. If all my amounts for each month stayed the same, then we only have to do these annual totals. So the premium amounts, $500 per month or $6,000 for the year. The second lowest cost silver plan, $4,800. The annual contribution amount is the $3,360 from up here. So the annual maximum premium assistance is going to be the $4,800 less the $3,360, $1,440. They would put a cap on that, limited to my premiums in column A. Doesn't come into play here. So my annual premium tax credit allowed is $1,440. Well, I got some advances up front of $1,200. So we reduce that out, and we're left with $240, which is an extra premium tax credit, refundable credit. We go over to the 1040, and there's my refundable credit, $240. If we go back to the 8962, we can reverse that scenario, and let's say it's $1,100. and then $2,200 for the year. The numbers change around here. So we have advances of $2,200. Premium tax credit is $1,440. We need to pay back $760, and that's underneath the maximum of $1,500. So we go over to the 1040 again, and we'll notice that that $760 excess advance premium tax credit repayment gets added into our taxes. Go back to the $89.62. That's it for page 1. Page 2 is kind of an edge case. If we have a shared policy with somebody who is not on this tax return, we need to allocate out the premium, second lowest cost silver plan, and the advance payments, kind of like a nominee distribution on a 1099-B. And you would punch in those percentages into the program, and then we would figure out what needs to be allocated to this taxpayer, and the amounts would get adjusted on page 1. The prime case would be a divorced couple where they went and got a shared policy, but then they're doing separate returns, and you need to allocate out the various amounts. Another edge case type situation, Part 5, alternative calculation for year of marriage. So if you get married during the year, it could affect the amount that you need to pay back. Okay, next we're going to go through another scenario with the penalty and the exemptions. So a similar setup here, taxpayer, spouse, joint return, 2 dependents, 1 over 18, 1 under 18. My wages, $25,000 for the year. I did not enter any coverage in the 1095B and C because we're not expecting many. But if we go over to this miscellaneous screen, the way we set up the product was we said, well, what if they didn't get B or C, but we want to indicate that there was coverage? So there's this miscellaneous section here, covered individuals. Everybody in the household, we're saying that they had coverage April, May, and June. On the 1095, I said that, changed it up a little bit. We said that they had coverage for January, February, and March. And then we scan down further, and we're saying that they want to claim some exemptions on the return for everybody in the household, but only for July, August, and September. And that's what we have here. So we go ahead and click on Forms, and we go to an 89. We go first to the worksheets, and there are 2 shared responsibility payment worksheets. And the first one is the main one. There's a big grid at the top that points out all the folks in the household, then every month, and the IRS wants X's by the months and the individuals where there was no coverage. So remember in this scenario, January, February, March, we said that they had coverage through the exchange. April, May, and June, they had coverage in the miscellaneous screen. July and August, we said that they had exemptions. So consequently, there's going to be a penalty for October, November, and December. Line 1, they want the total number of X's in a month. So it's going to be 4, 4, 4. Total number of X's in a month for individuals 18 or over. It's going to be 3, 3, and 3. We had one person who was under 18. 1/2 the number of X's in a month for individuals under 18. We said there was 1, so it's going to get a half, half, and half. We add them all up. We're left with 3.5. We would multiply that by $95. But the cap, remember the cap is $285. So we hit that here. The sum of the monthly amounts on line 1 is going to be 12, 444. And then we get household income. In this case, it was $25,000 of wages. Filing threshold, $20,300. Subtract that out, $4,700. Multiply it by 1%, 47. And then they wanted to figure out the greater of 1% of household income minus the threshold or the flat dollar. In this case, the flat dollar comes out to be greater. We go to the second worksheet here. And they have a different way of doing it. Because in this case, it's going to basically be 3/12 of the year because those were the months there was no coverage. The government kind of grosses it up first, and then they divide it out by the 3 months to get the monthly figure. So they say in 285 for the last 3 months. Then we go back up here. We're left with the 855, but we divide it by 12. I'm sorry, what I said before was you divide it by the 3 months. You multiply it by the 3 months and then divide it by 12. So we're left with 71, and that's based off of the flat dollar amount. Turned out to be greater than 1% of household income. And then there's an upper cap of the bronze level plan. And the government automated that for us. They said, let's look at everybody in the household because it's based on the number of people in the household where they didn't have coverage. We multiply 12 by the 204. The upper limit is going to be 2,448, and we're well underneath that cap. So the penalty amount of 71 goes up to the front of the return. Line 61, healthcare individual responsibility. And we can click on that link and go back to the $71 figure. If we change the facts just a little bit here, and we say that the wages were $100,000, calculate it out, go back to the worksheet, you'll notice that the 1% of household income is $797, but then we take 3/12 of that, and we're left with $199, and that is greater than the, as we saw in the previous example, what the flat dollar amount was. So in this case, the 1% prevails, still underneath that bronze level plan. So our penalty is $199. How do we check that box on the 1040? We go to screen 39, and we say entire household covered for all months. Put 1 in there, checks the box, turns off the penalty. Okay, what else do we want to point out on this one is the 8965. This is where the exemptions go. The first section are the marketplace granted exemptions, and I didn't have any on this test client, but we would stick that information in this section here. Marketplace granted coverage exemptions. And then there's a part 2, and these are automatically figured on the tax return. Coverage exemptions, household income is below the filing threshold. And in that case, you don't really have to do the tax return, but if you do the tax return, you would attach the 8965. Then we have part 3. These are the exemptions that we're physically claiming on the return. And remember, we said July, August, September, everyone in the household. So that's a good coverage of all the different functionality in LaCert. Now if I go over to Pro Series, you're going to notice it's very similar. So I'm not going to go as deep as we did with LaCert. The source documents are all listed in here. We have the 1095A, B, and C. And again, it's going to be pretty much identical to what we saw in CERT because all the inputs capture whatever was in the source documents. Have entries in the 1095A. And we're saying that the members in the household had coverage for the first quarter, and they would have gotten $500, or the monthly premium amount $500 for the first 3 months. Second lowest cost silver plan $400, and the advance is $100. No entries in the B and C, but we have this miscellaneous health coverage screen. And just as we said in LaCert, we're saying these folks had coverage April, May, and June. And we'll go to the 8962. Premium tax credit. We're saying household income $25,000. Won't go through all the computations here. The annual contribution amount works out to be $500 for the year, $42 per month. And we have just the first 3 months. The reason these are colored blue is I have an early version of the product that we were working with. So we have $500 per month, first 3 months of the premiums that we paid. Second lowest cost silver plan, $400. The difference between the two, I'm sorry, the 42 is from up here. That's what the household can afford to pay. And then we subtract that out, we're left with $358. Upper limit of that is the $500. So our premium tax credit, $358 per month. We got $100 per month up front. The difference between the two of the totals is $774. That's our extra credit that we deserve. Go to the 1040. And that's where that number comes in, 774. Okay, next we go to the 8965. Marketplace granted exemptions. We didn't have any, but they would go in here. And then part 2 is done automatically. That's where household income, gross income is below the filing threshold. Then the last section for 8965, it's on a SMART worksheet. We're saying that they had exemptions that they're claiming on the return for July, August, and September. Continue down. That's the actual 8965. Then we have a healthcare individual responsibility calculation SMART worksheet telling us whether we had coverage. We had coverage for the first 3 months from the exchange, miscellaneous coverage for the next 3 months, exempt for July, August, September, and no coverage for October, November, December. Continue on. This is the worksheet out of the instructions. The 285 figure. And we won't run through the math again, but it turns out to be $71. Flat dollar was higher. And there's the flat dollar amount worksheet. So that $71, we go over to 1040. Line 61. There it is. How do we turn that off and check the box here? Info worksheet. Everyone on the return was covered. Check that box. And we go to the 1040 again. Line 61, check the box and no credit. I'm sorry, no penalty. Another thing to point out here is the tax planner. We go in here. We got that individual shared responsibility payment coming over for planning purposes. And then we also have the net premium tax credit. We also have other functionality in the client organizer for both Pro Series and Lacert. We've added questions and fields to collect the right information. Another thing to point out here is the Lacert planner. If we go over to other taxes, click on the penalty worksheet. Minimum health insurance coverage. If this is no, we collect the data. How many household members under 18 or over 18? And then the product starts doing the greater of the two. It does it on an annual basis. We don't get down to the granular level of monthly calculation, but we do impose the new amounts going forward, $95 up to $325 and then $695. And then the 1% climbs to 2% and 2.5% for the next 3 years. And it's going to take the greater of the two. You need to punch in the national average bronze premium. If we go to the next tab over, payments, since it's a refundable credit, go to ACA credit. Was the insurance obtained through the exchange? If we say yes, then we start calculating the figures. Need to punch in the premiums of the second cheapest silver plan, premiums for the plan enrolled in, and any advances in order for us to figure out the extra credit that they'll receive or what they need to pay back. And it has the limitations on the payback. So that's it for the product demonstrations. Now I'm going to go back to the PowerPoint presentation. And we have a small business healthcare credit available to small businesses that offer insurance. It's claimed on the 8941. We just received the updated copy for 2014. The company must have less than or equal to 25 employees with an average salary of less than or equal to $50,000. The employer must cover at least 50% of the premium to qualify. The tax credit for small employers, including tax-exempt employers. The purpose is to help with the cost of providing health coverage for low and moderate income workers. The credit's been on the books since 2010 when the Affordable Care Act took effect. For 2010 through 2013, the credit was up to 35% for employers, 25% for tax exempts. And for 2014 and future years, the credit is up to 50% for employers and 35% for tax exempt. You must purchase the coverage through the shop or the small business marketplace in order to claim the credit. And it can also be claimed only for 2 consecutive years beginning in 2014. The employer shared responsibility provision or the employer mandate phased in over time. It was all supposed to take effect in 2014, but the government pushed it out in 2 different stages. Businesses with 100 or more full-time employees must offer insurance or face a penalty beginning in January of 2015. Businesses with between 50 and 99 full-time employees, not subject to the employer mandate until 2016. Businesses with fewer than 50 full-time employees are exempt. Applicable large employers, ALEs, must offer health coverage to their full-time employees and their dependents, or they're going to be subject to a penalty. In general, the penalty is $2,000 per year for every employee starting with the 31st employee. Here's a sheet with Affordable Care Act Online Resources. We have Intuit resources for accountants, and I'll show you the tools that we added. We had this web page. It was built a year ago last fall, and we had a lot of the general type provisions. But then most recently, about a month or 2 ago, we added this last tab, TY14 Impact. We have a tab for a guide for individual clients. And each of these documents, by the way, you can pull the information down in a PDF and use it in your practice. So we have a guide for individual clients. It explains ACA and the different situations at more of a high level, something that your clients can maybe understand. If I enrolled in a health plan through my employer, private insurance, Medicare, or Medicaid, what to expect in that situation. Next, we have a checklist for individual clients. And this is something that you would maybe supplement with the organizer to collect the right information. And here we list out whether the clients had coverage. You would send that out to them, and they would check the boxes, and they would also tell you some potential exemptions that you're able to get. Next, we have tools for tax professionals. Basically a big summary of what we're talking about today. Premium tax credit, penalty amount, and then the exemptions. Summary of the business provisions that we just went over. And lastly, an infographic, some of those estimates that I gave you earlier about the impact of ACA. So hopefully those tools will come in handy. We also have some interactive guides for LaCert and Pro Series. The IRS website does a great job explaining the provisions of the healthcare law. And all these forms are final now, the 8962 and the 8965. And you can punch those in here. I recommend reading those instructions. You can pull them up. Then you can also click on this hub here and get some information on ACA as it relates to the tax return. Some other helpful links, healthcare.gov, Small Business Administration, and Department of Labor. Okay, next we're going to turn our attention away from ACA and into some more general tax provisions that take effect for this year. Many provisions expired at the end of 2013, and under the Tax Increase Prevention Act of 2014, TIPA, Congress and the President have decided to extend these tax breaks for 1 more year until December 31st, 2014. And tax season will officially open on January 20th, 2015. So I'm going to go through Not all of them. You can use this as a reference guide, but go through the provisions that got extended into 2014. Deduction for school teacher expenses, tuition and fees deduction, state and local general sales tax deduction, mortgage insurance premiums treated as interest, exclusion for discharge of principal residence debt, tax-free distributions from IRAs for charitable purposes, all extended into 2014. The AMT, Alternative Minimum Tax Patch, was permanently extended 2 years ago. Depreciation Extenders. Section 179 continues to have a $500,000 limit and a $2 million phase-out for 2014. The treatment of certain real property as Section 179 property and 50% bonus depreciation stays in effect for this year. Business extenders, the research credit, work opportunity credit, employer wage credit for employees who are active duty members, the exclusion of 100% of gain on small business stock, all extended into 2014. Basis adjustment to stock of S corporations making charitable contributions of property, and the reduction in S corporations recognition period for built-in gains tax. Energy-related extenders, the popular non-business energy property credit for energy-efficient homes, energy-efficient homes credit, new homes credit, energy-efficient appliances credit, all extended into 2014. Some other miscellaneous tax law changes. To enhance efforts to combat stolen identity refund fraud, only 3 direct deposit refunds are allowed per financial account by the IRS. Any subsequent refund converts to a paper check and it's mailed to the address on the return. Direct deposit only into an account with the taxpayer's name, and no portion of the refund may go into the preparer's account. Electronic signatures allowed on forms 78 and 8879, the electronic filing authorization signature forms, in an effort to reduce office expenses and the burden on preparers and taxpayers. No specific technology is required. Identity verification is required. And you can find more information on irs.gov/eSign. Intuit products will use DocuSign for electronic signatures as a vendor this year, and it's incorporated into all of our tax products. IRS Direct Pay, a new web-based system for paying tax bills and estimates directly from a checking or savings account without a fee. Some of the features include receiving instant confirmation, always available. You can make a 30-day advance payment. Personal bank account information is not retained by the government. To learn more, access Pay Your Tax Bill icon at the top of irs.gov. And this service was used by over 150,000 individuals last year. Standard mileage rates for 2014. Business, 56 cents per mile. Medical and moving, 23.5 cents a mile. Charitable, 14 cents a mile. The government has recently issued 2015 standard mileage rates. To go to irs.gov. Just punch that into the search bar, 2015 standard mileage rates. Some non-inflation adjustments here. A lot of these numbers stayed the same. So for 401k or elective deferrals, no change. $17,500 for a base, $5,500 for catch-up for those over 50, and $23,000 total. Simple plans, no change, $12,000 base, $2,500 catch-up, $14,500 total. IRA deduction, no change, $5,500 base, $1,000 for catch-up, $6,500 total. The IRA phase-out ranges got bumped up by a little bit. The range is now for single head of household, $60,000 to $70,000. And for joint qualified widow, the range now is $96,000 up to $116,000. Okay, now an IRS initiative that they released over the summer on the heels of Loving versus the IRS. The District of Columbia Circuit Court of Appeals held that the IRS lacks authority to enforce the Registered Tax Return Preparer Program. Regulations would have required paid preparers who are not attorneys, CPAs, or enrolled agents to pass an exam and take continuing education classes. The IRS didn't think they stood a chance to appeal and win the case, so they're implementing a new annual filing season program, voluntary program to encourage unenrolled preparers to participate in continuing education classes. About 60% of preparers operate without any type of oversight or education requirements. Some of the benefits: stay up to date on tax laws and changes, reduce the risk to taxpayers from unknowledgeable preparers, and it allows preparers to stand out from their competition. You would need to complete and pass an annual federal tax refresher course and obtain CE by December 31st prior to tax season. Upon doing that, you receive a record of completion, and there are some exemptions. If you pass a recognized national or state level test, such as the ones they have in California and Oregon, if you pass the RTRP test and the SEE Part 1 test, FIDO volunteers, and other accredited tax-focused credential holders. And those exemptions are shown, or the implications are shown on this slide here. If you're non-exempt, for 2015, the CE totals are phased in, so they're a little bit less since it's a transition year. 6 CE credits for annual federal tax refresher course and test, 3 CE credits for federal tax law updates, 2 credits for ethics for a total of 11, and then those exemption folks from this slide here at the bottom there, they would have to get, for 2015, 3 CE credits for federal tax law, 2 CE credits for ethics for a total of 8. If you're an attorney, a CPA, or an EA, you have continuing education requirements affiliated with your designation. So you wouldn't, this chart would not apply to you. You'll be included in a new public directory on irs.gov by January 2015. I haven't looked out there yet to see if it's out and posted. It will also include attorneys, CPAs, enrolled agents, ERPAs, and enrolled actuaries. Unenrolled preparers who participate in this program are subject to the Circular 230 regulations. Beginning in 2016, only AFSP participants who obtain a record of completion will have limited representation rights before the IRS. Okay, we have come to the conclusion of the content. Now we're going to go through some questions and answers.
Hi, Mike. I just want to make sure you can hear me.
I can, yes.
Okay. Well, I'll go ahead and start off with the questions. Where are we supposed to find the amount of the monthly premium of the second lowest cost of the Silver plan for our clients?
Good question. Fortunately, this amount will be provided on the Form 1095A, which is issued by the Health Insurance Exchange. A lot of people are confused about that. Where do I get this number from? Fortunately, it's issued by the exchanges and given to you. And I think those 1095s are starting to go out, so you should receive those in the course of January.
Great, thank you. Next question is, if an employee is covered on their job for insurance, will they receive the Form 1095A with their W-2?
Good question. The answer is no. The 1095A is only issued by the Marketplace, if that's where they got insurance from. If you were an employee and had coverage through your job, depending on your employer, you may or may not receive a 1095C or potentially a 1095B from the insurance company. So you'll have to just speak to your clients if you don't get those forms and try and verify whether they had coverage.
Okay. Next question is, a taxpayer who bought insurance through the Marketplace and estimated their 2014 income and now files showing higher income, will they owe the IRS back part of or all of the subsidy?
Yes, but the IRS won't necessarily reduce their refund by the entire subsidy. You need to run the numbers to find out how much you need to pay back because it could be limited. As I showed you in the chart earlier, it's dependent on your household income to your federal poverty line, and the government puts limits in based on where you land in the FPL. If you're over 400% of FPL, then you got to pay the difference all back. So it's just going to depend on how much income has gone up.
Great. Okay. This next question is in regards to filing deadline for taxpayers who during 2014 did not claim the subsidy but are eligible to receive it when they file their return. The IRS regulations say taxpayers who receive an advance on the subsidy must file by April 15th. There's no mention of when the taxpayer who did not receive an advance subsidy as to when their filing date is. Can taxpayers waiting to claim their subsidy file after April 15th?
Good news is yes. There's a lot of information floating around the web and different places, so it's a good question. It's the same deadline in either scenario. Whether you claim the upfront subsidy or not, as we saw earlier, you'll need to file the 8962, which reconciles the subsidy, whether you got it or not, with what the actual credit's supposed to be. So the premium tax credit flows into the 1040, and you're going to have the same deadline, whether you had subsidies or credit or not. It still goes into the 1040, and the deadline is going to be April 15th, plus any filing extensions.
Great. Okay, my next question is, a client has W-2 earnings of $150,000, a net operating loss carryover from prior year of $130,000. So modified adjusted gross income is $20,000. The client has insurance from the Marketplace. Do they qualify for a premium assistance credit? It seems like the net operating loss and the capital loss carryovers should be added back into income.
It's a good question, but I think the good news for taxpayers is that the government does allow you to reduce, or when you're arriving at household income, the starting point is adjusted gross income. And the only add-backs are tax-exempt interest, foreign earned income exclusion, and non-taxable Social Security benefits. So you will benefit from these carryovers from prior years. Whether the taxpayer qualifies for the credit depends on the number of people in the household. and how their income, household income, relates to the federal poverty line. So good question, but good news is you don't have to add back those carryovers.
Okay, the next question is, if a taxpayer's household income is below the filing threshold, does he or she have to file a return to claim the exemption?
Another good question. There's a lot of confusion about this. Hey, why do you have that? You have that exemption on the 8965, household income being below the filing threshold, but in that case, I also don't need to file a return, so what's right? The IRS does address that in the 8965 instructions. What they say is, if you're not required to file a return, your household income is exempt from, or your household is exempt from the shared responsibility payment, and you do not need to file a return to claim a coverage exemption. However, if you're not required to file a return, but you choose to do so anyway, please claim that exemption on line 7A or 7B on the 8965.
Okay. Will clients be considered exempt for the whole year or just the months they are enrolled with Medicaid?
Coverage under Medicaid is considered minimum essential coverage. So the enrollees would have coverage for those months only. So it's not considered an exemption, it's considered coverage, and just for those months. For the other months, they're either going to be subject to a penalty unless they have an exemption for one reason or another.
Okay. Do employers qualify for small business health tax credit if the employer provides health insurance, but not through the marketplace?
The answer is no, unfortunately. You must go through the shop marketplace or the small business marketplace to be eligible for the credit.
Okay. And I have time for 2 more questions. If I already took the RTRP test in the beginning when it was mandated, do I need to take the CPE each year or also for the end of 2014?
You do have to take CPE, but it's at a reduced level. You're considered, if you take that RTRP test, you are considered an exempt preparer, but in that case you do still need to take CE, but it's at the reduced levels, and I pointed out to that chart. If you go out to irs.gov and type in the annual program, it brings up the requirements. You can see that chart and find out what your requirements are.
Okay, and this is our last question. If a person over the age 55 who is unemployed and is not eligible for Medicare, will they get penalty for not having insurance?
Yes, unless they're covered by an exemption. You would go to the 8965 instructions to see if you qualify. Maybe your income is going to be low enough, or there's many other situations out there. So I would go out to the 8965 instructions, read up on the exemptions, and then they elaborate on some of those other hardship exemptions on healthcare.gov. So I would recommend those 2 places.
Okay. Well, I want to take this opportunity to thank everybody for listening in on a recorded webinar. We will have additional resources. Please make sure that you keep our ACA website that's referenced in this webinar available. That is most likely where you'll find additional resources for you and your clients. Mike, thank you for taking the time to present for us today.
Thank you, Amy, and thank everybody for attending and participating and using our products. I wish you a smooth and prosperous tax season. Take care.
Thank you.